I'm getting a lot of calls from people saying, I got a bunch of debt. Should I cash in my investments like RSPs to pay off my debt? Ted and I were going to record a podcast answering that question, and then we thought, wait a minute, we did this podcast already. I'm pulling it out of the vault. Here it is.
This is Debt Free in 30. Here's your host, Doug Hoyes.
Sometimes it makes sense to sell your car or house or cash in your RSP or other investments to pay down your debt, but that's not always the wisest choice. There are a lot of factors to consider before you start having that yard sale or advertising on Kijiji or cashing in your retirement savings or refinancing your home. You want to make sure that whatever choices you're making are going to solve your debt problems and leave you better off financially. Does it make sense to sell your stuff if you still end up with more debt than you can repay? That's today's topic here on Debt Free in 30. What are the best debt reduction strategies when you have assets? Now, I know our longtime listeners are listening and saying, I know where you're going with this. You're going to talk about your favorite topic, consumer proposals. Yes, consumer proposals will be mentioned today, but the answer is not as simple as file a consumer proposal if you have debts and assets. There's a lot more to it than that. So it's time for our second Technical Tidbits edition in a row, where we deal with one specific issue faced by our clients. So to do that, I'll welcome back Ted Michalos, my Hoyes Michalos co-founder and business partner. So Ted, last week we talked about inheritances and bankruptcy. Today the question is, how can you reduce debt if you have assets? Is this really just the same show all over again?
They're completely different. So last week we were talking about you file bankruptcy and you come into a windfall, some kind of inheritance. So you're already in bankruptcy and there are very specific rules. Today what we're going to talk about is I've got stuff that has value, equity in a house, car, investments, whatever, and I'm trying to decide what I should do about it. So bankruptcy might be an option, but we haven't made that decision yet. So they're dramatically different topics.
Totally different. Okay.
Totally different.
So you mentioned the word assets, and that, okay, that's a pretty
technical term.
Well, it means everything you own, right?
Right.
An asset is something you own, and obviously there's lots of different kinds of assets. So let's start with the most basic question. Are all assets treated the same?
And they certainly aren't. There are a number of assets that are protected under the law. But so let's talk about it in broader terms. Something that you own, you might actually own it free and clear. So say you've got a car that you don't have a loan or lease against. You own that outright. Let's say you've got an asset that's used as collateral or security for a loan. So instead of that car being owned outright, you still owe money to somebody for it. That's called a secured debt. If you don't pay for it, they can take the asset. It's not really yours yet.
And so if you have debt and you have a secured asset, well, you can't be selling that secured asset.
It's not yours.
It's not yours.
Right. Well, and then there's another group of assets that you may own free and clear, but they're protected under the law. Each of the provinces in Canada has something they call an Executions Act, and they basically detail what things cannot be taken from you by your creditors. And it's important to understand what those are.
So you're talking about bankruptcy exemptions. So let's go through those just so people have them in their heads. And we're not going to mention specific numbers here because, number one, the exemptions change over time. So if you're watching this video in the future.
Well, and they're different in every province of Canada.
Yeah, so we don't want to be too specific. But in general, so in Ontario, basic household goods.
Right. And so that means your basic furnishings, things you need to survive, your kitchen pots, all that sort of stuff.
What about cars?
So the provinces are all a little bit different. So each of the provinces has some kind of threshold. So I'm going to use a number, even though you just said we weren't going to. In Ontario, you're entitled to a vehicle worth up to $6,600.
And we're recording this early in 2019. If you're watching this in the year 2050 or something, it might be different.
Check.
Although they don't change the numbers every year.
Yeah, it's not indexed to inflation or anything.
It's whenever they get around to changing it. So if you have a car that's worth less than $6,600 and you go bankrupt, no problem. The trustee isn't going to take it. If that car has a loan against it, then what happens?
Well, so to keep the car, you've got to continue to make your loan payments. As long as you don't have more than $6,600 worth of value in the car, it's not affected. But don't just think about in bankruptcy. So these exemptions apply to creditors, too. If somebody sues you and you've got a car that's worth $5,000, they can't make you sell the car. It's protected under the law.
Which is what the Execution Act is all about. So there are other ones as well, tools of the trade. What does that mean?
Yeah, so if you have something that you need to actually do a job. So a perfect example is a tradesman. I'm a carpenter. I need my saws, my hammers, my ladders to do my job. well, they're protected under the law because if we took all your stuff, you couldn't make any money.
So up to a certain limit, they're protected. We're going to talk about RSPs and home equity and some other things as we get going. So the basic point is some things are exempt, and other things, if they are secured, if there's a loan against it, then you either give them back or keep paying the loan if you can't pay it. And again, we're talking about specifically in a bankruptcy situation.
Yeah, I mean, if you want to bring this back to the topic is I've got stuff that I own, what should I do about dealing with my debts? People obviously, they think of, well, I'll sell my stuff. And that's what most people do before they call us. A lot of that stuff is protected under the law. You didn't need to sell it. And at the end of the day, it probably didn't help.
That's a key point. You didn't need to sell it.
Yep.
So, and in fact, most of the bankruptcies that we deal with, the people don't lose anything.
Well, that's right, because if they had something, they've already sold it, even though they probably shouldn't. I mean, that's just the nature of people. You do everything you can to try to deal with your debts. Calling somebody like us is usually the last thing they think of because they don't want to. Unfortunately, if they did it a little earlier, probably we could have filed a proposal for them or found a different strategy.
I knew we'd get to proposals eventually. It wasn't even in the script yet there,
Sorry,
but we got to it soon.
Yeah.
Okay, so the most obvious asset that I see being drained, if you want to use that term, is an RSP.
Yeah, it's the biggest mistake people make.
And the reason they do that is because, well, I can turn it into cash.
Well, and because the creditors often, they suggest it. Well, we see you've got money in a retirement savings plan. If you cash that out, you could pay us off.
And the creditors know that because if you have a loan at Bank ABC and you also have your RSP at ABC Bank, then they know that it's there. Obviously, they don't know about stuff that's in other places. But so, I mean, the classic case I see, and I see this all the time, I'm sure you see it all the time too, you know, somebody comes in, they've got $40,000 that they owe on, you know, credit cards, bank loans, taxes, payday loans, whatever, unsecured debt, which is what you've already explained. And they've got $50,000 in an RSP. So it seems like a pretty obvious answer. Well, okay, cash in the RSP, pay off the debt, bing, bang, boom, we're good.
Right.
What are the flaws with that strategy?
Okay. So the first mistake is if you take $50,000 out of your RSP as one big lump sum, the tax hit you're going to take on removing it is huge.
You pay taxes.
Yep, and we can go through what those specific thresholds are if you want. That maybe that's useful information.
Yeah, I mean and these are all federal limits, so it doesn't matter what your province you're in. So if I take out $5,000 or less,
it's 10% tax.
And then between $5,000 and $15,000,
20% tax.
And over $15,000,
it's 30%.
30%. Now, if I take out $100,000 for my RSP, and I also have a job where I'm making $100,000 a year.
Yep.
I've paid 30% tax on that RSP when a withholding tax.
Right.
What's my tax hit?
Well, you probably, because of your income, are in the 47% tax bracket. So you're short $17,000 of taxes on that $100,000 you took out.
And you aren't going to find that out until next year when you file your taxes.
Correct.
This is the problem.
And that's that's an obvious answer, but the one that actually gets people is when they take out that $5,000 and the government holds back $500 and you're already making $50,000, they should have held back $25,000. So suddenly you thought you did the right thing and you got a $10,000 tax bill that you can't pay.
Yeah, you pay tax at whatever your marginal tax rate is, which is the tax you pay on all of your income, not just on one piece of it. And it's very common that, okay, I need some money, I'll go take $5,000 out. And then 2 months later, I'll take another $5,000. And 2 months later, I'll take another $5,000.
Well, and in fact, there are planners that'll tell you to do it that way so you reduce the amount of tax you take, which just gets you in trouble.
All you're doing is setting yourself up for a huge tax bill at the end of the year.
Well, and there's another hit to this one. So let's say the creditor convinces you to take $5,000 out of your RSPs to make all the payments that you're behind. Well, you still have the rest of the debt. All you've done is catch things up. You're out the RSP, which may have been protected under the law anyway, so you still got to deal with this problem. So now you've been hit twice when you're trying to do the right thing. No good deed ever goes unpunished.
There you go. Ted
Tombstone.
says that all the time.
Yep.
And so I'm at Bank ABC. I owe them money. They say, hey, we know you've got an RSP here. Cash it in, pay us out, take it out in $5,000 increments so you get more money. So Bank ABC is happy. All my other creditors aren't getting any money, and then next year I get whacked with taxes. This is a huge problem. So,
well, there's one more angle to this. People are probably wondering, well, if I got an RSP, why can't I just use it as collateral on a loan from Bank ABC? Because as soon as you use an RSP as collateral, it's no longer an RSP, and so it loses its tax-free status. That's why the banks won't let you use it as collateral. That's why they don't suggest it. Cashing it out is great. You pay the tax. Borrowing against it can't be done.
Yeah, an RSP is not able to be used as collateral. Now, I know people are listening going, yeah, but okay, it's now we're coming into the spring if you're watching this when this came out, and there's going to be all these ads, borrow to put money in your RSP. We'll give you an RSP loan. There really is no such thing as an RRSP loan then in the sense that there's a car loan or a mortgage.
Right. It's just a marketing gimmick. We're going to lend you money, and we're going to strongly suggest that you put it in your RSP.
Well, and if I borrow it from the bank and I have an RSP at the bank, then they'll just, when I get the loan, they automatically put it right in the RSP, so they know it goes in there.
Yep.
But it's not a secured loan in that sense. So now, we often meet with people who've taken money out of their RSP.
Yep.
They pay down their debt, but they don't pay it down in full.
Right.
And then they end up filing bankruptcy after having wiped out most of their, retirement income. And,
right.
Obviously you're alluding to the fact that there may be a better strategy. And we talked back on podcast number 209 about whether or not you should use your RSP to pay off debt. I'll put a link to that episode in the show notes. But in a nutshell, the tax costs of withdrawing money from your RSP mean you don't have enough money to pay off all your debts. Then you should probably leave your RSP where it is and talk with a licensed insolvency trustee first. Now, you already said that RRSPs are largely exempt in a bankruptcy.
Correct.
And this is a key point here because this is a law that has changed over the last 10 years. People may not be fully aware of it. So you're, of course, referring to good old Section 67, Sub 1, Sub B.3.
Of course I am.
Of the Bankruptcy and Insolvency Act. And the reason it has such a weird section number is because it's a relatively new section of the law. And, they couldn't. It's like when you build a house in the middle of two houses.
It's an amendment that they added later.
You got to have a funny number. So they couldn't just make it paragraph 2, so they made it paragraph B.3. And it says that the property of a bankrupt shall not comprise property in a registered retirement savings plan, that's an RSP, or a registered retirement income fund, which is a RIF, or in any prescribed plan other than property contributed to any such plan or fund in the 12 months before the date of bankruptcy. So translate that into English for us.
So if you haven't made a contribution to your RSP in the last 12 months, it can't be seized. The funds are protected. And that's for all RSPs.
All RSPs. Now, some RSPs are locked in anyways.
Correct.
In which case, well, okay, it's locked in, then it's locked in. The trustee wouldn't be able to take it.
Well, and some have an insurance component to them that they're protected under a different law. I don't know if we need to talk about that either.
No, and that's a much less common thing than we've seen because with this revised law, then, well, an RSP is protected. So you lose, if you go bankrupt, you lose whatever you've put in the last year. So we often have people who come in, they're on some kind of RSP plan at work. They're putting in $50, $100 a paycheck, something like that.
Yep.
So anything you've put in the last 12 months, you're going to lose.
Right.
So when that person comes in to see you, so let's go back to this scenario I posed. Guy's got $50,000 worth of debt, and he's got I guess the scenario I posed was $40,000 in debt, $50,000 in an RSP.
Right.
And so you're saying, well, okay, but if you take the money out, you're going to end up paying tax, so you won't get the full $50,000.
Right.
In fact, you won't even get $40,000 if you carry it all the way through.
Correct.
Unless, even if you had zero income for the rest of the year, you're probably still going to lose money. So, okay. What am I supposed to do then if I have some money in an RSP? It's not enough to pay off all my debt. What are my choices?
Well, so you need to think of an RSP. You can't think of RSPs as money. It's not something that you have. It's money that you've set aside for tomorrow. So you don't have it. It's not there. So you need to consider your situation. Should you be filing a consumer proposal? Or maybe you should even be looking at bankruptcy. It's the mistake people make is they think they've got this thing that they can cash out and there are no consequences. Well, it's supposed to be for your future self. Don't think that you own your RSP. Think that Ted 50 years from now owns the RSP and you can't touch it.
It's my future self. So I have people come in all the time and they're in that situation where I'm contributing through work. So if we're going to end up having to do a bankruptcy, then my first piece of advice is to them, well, you might as well stop contributing.
Right.
Because if we're not going to file the bankruptcy till next month or the month after,
at least you'll have that couple $100 in the bank.
That's right. So and it's a couple $100 I'm not going to be taking from you because it's 12 months. You take the bankruptcy date and go backwards.
Correct.
So if I don't make a payment this month, well, then I guess I'm only going to lose 11 months payments if I delay the bankruptcy. So there is some planning points there in terms of timing. Most people aren't going to wait a year to file because of the $50 they've been putting in.
Right.
But there may be some advantage to giving it a little bit of extra time. So now Section 67.1 of the Bankruptcy and Insolvency Act talks about RRSPs and RIFs, and you've explained how that works. There's this 1-year limit. What about things like TFSAs, RESPs, money in my stock trading account. What happens with those?
I'm pretty sure you talked all about this stuff in your book. Maybe we should just send people there.
Yeah, let's just stop the recording now, and everyone can go to.
It's a copy that everyone has dog-eared. And
That's right. I assume you've all. It's page 88, Straight Talk on your money, where I talk about a debt reduction strategy when you have assets. So, and yeah, I mentioned TFSAs, RESPs, all that kind of stuff. So. Let's see if you give the same answer as I give then. So somebody who's got a TFSA, an RESP, and I'm giving examples of assets that are not exempt in a bankruptcy.
Correct.
So what kind of advice do you give people who have those types of assets?
Well, so you've got to assess what the value is of those assets. But if you've got $10,000 in a tax-free savings account and you have $10,000 worth of debt, if you file bankruptcy, we'll cash out that tax-free savings account. So you should just cash it out yourself and pay off the debts.
Yeah, there's
really no reason to involve a bankruptcy. Because the asset isn't protected.
Yeah, you're losing the asset anyways, so why have a bankruptcy on your record?
Right.
And not have the asset?
Yeah.
It doesn't really make any sense.
RESPs are a little more complicated because, again, you're setting aside money for your kids' future. So if you can, I strongly recommend proposals over bankruptcies when RESPs are involved because the penalty to your children is too great.
Yeah, and we're talking registered education savings plans, is what we mean by RESPs, which is money you've set aside. And there are some complications to that as well, because even if you were to go and cash it out, there are fees that might have to be paid.
There's a tax hit.
And then there's it's not so much a tax hit as you lose the grant that has been put in by the government. So yeah, it's essentially you don't get it all. If you got $10,000 in your RESP, you don't get $10,000 back. And there may be a tax hit as well. If the plan is increased in value, then there may be some gains. So much better. And the other thing I also see fairly frequently is that the RESP is held by both parents.
Right, which complicates things.
Yeah, so if you go bankrupt, you might end up losing half of the value your spouse wouldn't. So if you've got an RESP, and particularly if your kid is a teenager, so you've been contributing for many years, you're going to need it soon, and it's got more value. That's definitely where you want to be getting some advice from a licensed insolvency trustee first. So, stocks, I guess, there's some tax implications there if you cash them in, but you're going to lose those in a bankruptcy as well.
Yeah, you've got to look at your return on the investment, what kind of gain you've had on the stocks. Are you actually going to sell them at a loss? It's not a simple, straightforward calculation. But if it's something you're going to lose anyway, then it makes a certain amount of sense to cash it out before you consider bankruptcy.
So the thought process then is, if it's something I wouldn't lose in a bankruptcy, like an RRSP, then okay.
So I just want people to consider RRSPs as not something that they own. Just ignore them. It's not an asset that you have. You put the money in it, and the money's gone until you draw it down in the future.
So that makes it simple. The other things... so stocks in my stock trading account.
Okay, so I've got cash there. I've got debts. I'm going to lose these to either my creditors if they sue me or if I file bankruptcy. So it probably makes sense to cash them out and pay off the debt.
But there could be a tax implication to
There
that.
certainly could be, yep.
If you have capital gains, then there may be taxes to pay. Although I guess if you're going bankrupt, then that becomes less of an issue if they're cashed out.
Right.
So the thought process then is, how much is there? How much would I get if I cashed them out?
Right.
How much tax hit would I have to pay?
Yep.
And then based on that, is it enough to clean up my debt? So let's say I do that math, and all my stocks in my stock trading portfolio, if I sold them and paid the capital gains tax or whatever on it, would come to $25,000, and I've got $50,000 worth of debt.
Okay, so let's go back now to the consumer proposal.
Okay, good. I was hoping we'd get to that.
Because you got to remember, folks, the idea behind a proposal is you're saying to your creditors, I can't repay all of my debt. I'm going to repay a portion of it. Well, so they may be entitled to all that money in a bankruptcy. You offer it to them in a proposal. You're not filing the bankruptcy. The creditors get the same amount of money. They're relatively indifferent to that. They want the money. Mm-hmm. They don't want to penalize you by forcing you into bankruptcy. They just want what they're entitled to.
So in my example, I've got $25,000 worth of potential value there. What would the proposal be?
We have to determine what a bankruptcy is worth, and you offer your creditors that same amount, but probably we'd be offering them $25,000.
So if there were no other assets, if you had no other surplus income, no other complicating factors, then it could be as simple as, okay, I'll cash in the investments and I'll make a lump sum proposal.
Right. And folks, we can't stress this enough. So if you cashed out those investments and got the $25,000 and paid down the debt, you still have $25,000 more in debt that you've got to deal with. and now you've got no means of doing that. By offering them a proposal, even though you're offering them less than what you owe them, that's the amount of money that they're going to recover if you exercise all your rights under the law. So it actually makes sense from the creditor's perspective too. I mean, there's no fight here. You're voluntarily saying, I'm going to give you what I have to give you.
Now, I could go either way with that then. So I could say I've got this money in my stock trading account, and maybe it's sitting there at my brokerage company.
Yep.
So, and it's worth $25,000. So I could say to the creditors, I'm going to do a proposal. I'm going to cash it in, give you the $25,000. I know I owe you 50, take it or leave it. They'll probably take it. I could also, though, say, well, if I went bankrupt, you get $25,000. I'll give you the $25,000, but I'm not going to cash in my investments to do it. I'll do a proposal over a period of 5 years where I'll pay you, I don't know, whatever that is a month.
$412.50 a month.
$412.50 per month.
There you go.
Over a 5-year period, which would come to $25,000. People can pull out their calculators and fact check Ted on his math number there. So what should I pick? I guess part of it depends on what I think that investment's going to do.
Right.
You're taking a big risk, though, too, if you leave it in there.
What you're really doing now is you're falling back on before you make any of these decisions, you should be talking to a licensed insolvency trustee. All of these options are beyond the average person's ability because you don't deal with this every day. Come and see somebody like you, somebody like me. This is what we do for a living. We're back to if you have a sore tooth, you go to the dentist. You don't go to the hairdresser.
I don't. So we can crunch the numbers and help you out. I mean, if you cash in the investment, you don't have the investment anymore. But I mean, as we record this in early 2019, the markets have been pretty volatile, up, down, up, down. Yep. So maybe now's the time to say, you know what, cash it in, take the money, pay off my debts, fresh start, do a proposal, whatever. And that way, if the markets continue to be volatile, and if they go down, well, it doesn't matter, I've cashed out. Right. As opposed to, I want to keep that investment because I really think my Bitcoin's going up, and you should
call us anyway. Then
that's right.
Yeah, Bitcoin.
But nobody made money in 2018 on that investment.
Right.
So you may be better off to cash it in and cut the risk, as opposed to holding on to it, agreeing to pay $412.50 a month for the next 5 years, only to see that your investment is going down in value. So now, one more point I want to go back to, and that was RESPs.
Yep, registered education savings plans,
which are not exempt.
Correct.
But in Alberta, they are exempt?
Yeah, each of the provinces sets their own execution act with their own protections for the things that people have. And unfortunately, right now, where you and I both live, Ontario, we're offside on the law. It's just a stupid law.
So that was my question. Do you think it's a stupid law?
Yes, I think it's a stupid law.
And so why do you think it's a stupid law? Why? In other words, you think RESPs should be protected in a bankruptcy similar to the way RRSPs are protected?
Right. So once the government made the decision to protect registered retirement savings plans, they said, we're trying to protect the money you've set aside for your future self. And it impacts mostly older individuals. You're protecting adults. Well, RESPs, you're trying to set aside money for your children's future selves. And so what we're saying by not protecting them is the value of protecting the future of our children is less than the value of protecting the future of ourselves or our parents. And it adversely affects single parents, single moms more than it does, say, a middle-aged white guy like me.
Why is that?
Well, because the single mom, she'll scrape and save every penny she can for RESP for her kid's future. Whereas, I'm a 57-year-old white male. I am saving for my retirement. What do I care about an education savings plan? It doesn't impact the same group of people. And it's not fair, the people that it is impacting.
You're 57 years old.
Sorry to hear that.
Good Lord.
And a perfect face for radio.
There you go. So unfortunately, these are on video too. So,
right.
And I think, we have already passed our comments on to the governments of the day.
Yes, and quite clearly.
And nothing has come of it. But and I understand there's the potential for abuse here, but that's why in the RRSP rules, you have to wait.
12 months.
You can't just put $1 million in today and go bankrupt tomorrow. There's this 12-month waiting period. I think we all agree that's reasonable. With RESPs, you can only put in $2,000 or $3,000 a year anyways.
$2,500.
$2,500, and so I guess there's a catch-up provision if you haven't contributed. But no one can dump $100,000 into an RESP. So as an anti-avoidance thing, okay, that's not really where fraud is happening.
Right.
And you're right. It tends to be the person who, like a multimillionaire doesn't need an RESP. They'll just pay for their kids' education. Who cares? Right. But if you are, have less money, and so it's very important to save.
It's the single moms. I mean, call a spade a spade. They're the ones that are penalized the most under the RESP rules.
And so we would encourage the government, if you're listening, Mr. Trudeau, then
make a change.
That would be something that we would like to see exempt across Canada.
I'm not likely to vote for him ever.
No,
anyway,
I understand that. Well, maybe he'll make this change for us, and
it'll
all be good.
Okay.
So, final asset we're going to talk about, and that's, of course, the biggest asset that anyone typically would ever have, and that is a house. And you and I did a prediction show at the end of 2019.
2018.
At the end of 2018. It was our 2019 prediction show. That was show number 226. And it's already been viewed a lot and downloaded a lot and been in the media because Ted talked about it and the media picked up your prediction that insolvencies are going to go up 10% in 2019.
I probably underestimated that, folks.
So far he's tracking exactly right on that, but we'll know soon enough. And in that show, we made the point that for the last few years, nobody, and I'm exaggerating slightly, but essentially nobody who owns a house has had to file a bankruptcy because the equity's been so high. The house goes up in value. I can refinance it. I can sell it. I can pay it.
Right.
But that is no longer the case here in 2019. We're certainly seeing lots of evidence that outside of the Toronto area, house prices are really starting to come down, particularly for things like single detached houses. Condos are still holding up fairly well. Yeah. So what's the rules if I own a house and have to file a bankruptcy?
So the issue is any equity you have in the house, that's the net worth in the house after all the closing costs, the mortgage, and all those things are paid, is subject to seizure by your creditors. So they can, basically, if you have equity in a house and you file bankruptcy, we need to get that equity out.
It's pretty much that simple. And at the end of December, our Ted Michalos Homeowners Bankruptcy Index was at an all-time low of 3.9%, meaning less than 4% of our clients owned a home at the time they filed either a bankruptcy or consumer proposal. We're certainly projecting that number will be much higher in 2019.
Significantly
higher. So if you own a house right now and you have debt, then the thought process is, what's it worth?
Right.
And can I borrow enough against my house to deal with my debt? And so if my debt is a line of credit at 4%, maybe I'm not so worried about it. If my debt is a credit card at 19.9%, then can I borrow against it?
Yep.
And what are you seeing on the street right now with people's ability to borrow against their home as compared to prior years?
So literally 6 months ago, it was much easier to get a second mortgage or refinance your house to tap into that equity than it is now. I'm not exactly certain what's happened in the market other than the real estate market in general has softened. There haven't been any new government rules.
No, the
big
big
mortgage rules last year.
Right. They were at the start of 2018, but those are the rules that are now filtering through. So
that's made it harder for people to buy houses.
Yep. And, which then flows down to everybody else on the refinancing and everything else. So if you have to qualify at a higher rate than what is posted.
Yep.
So the house is worth less, and I've got to be able to pay more, in effect.
Correct.
And with interest rates going up, it's really causing some consternation. I've heard from a number of mortgage professionals over the last 2, 3, 4 weeks that, we're getting turned down on deals that 6 months ago would have been good. So the ability to refinance and pay off your debts is becoming less, which again comes back to the whole consumer proposal thing.
Sure.
Okay.
Earlier this week, I had, something crazy, 10 consultations with people in trouble in one of our offices. 5 of them had house equity issues. So is there any way we can borrow against this equity to pay down this debt? And I'm certain that in 4 of those 5 cases, they will not be able to do so.
And they'll be back.
We have to find another solution.
So we've been talking about, in a bankruptcy, you lose this stuff. Here's how it all works. But why does that matter if I'm going to end up filing a consumer proposal? So who cares what's going to happen in a bankruptcy? I'm filing a consumer proposal. Why are you talking about all these exemptions and all these other issues?
So for people that aren't familiar with this topic, the idea behind a proposal is you're saying to your creditors, I'm going to repay a portion of my debt. You're required to offer them more than they'd get in a bankruptcy. And the reason for that is simple. So if you offered somebody less than they get in a bankruptcy, why would they agree to your deal? They'd rather have you bankrupt. So the reason we keep talking about bankruptcies here is that we need to know what a bankruptcy is worth. So it's based on the assets that are exempt, things that are protected, what can be taken and seized from you in a bankruptcy. That impacts what you have to pay in a proposal.
Yeah, and people don't like us talking about bankruptcy, but you got to understand that so you can understand what the proposal is worth. I mean, you go to the doctor, well, I can do the surgery or I can do this. Here's what happens in this one. Here's what happens in that one. And that's really what we're
if you want the
talking about
comparison is we'll put you on the pill regimen to solve the problem. If you don't take the pills, eventually we're going to have to do the surgery.
So let's explain the implications of both.
Let's try the pills.
And then you can decide. Yeah, and obviously the consumer proposal is a less invasive procedure right off the bat.
Medical.
Very good. Invasive, yeah. I don't know what it means, but so okay, I think we've talked about what happens asset-wise. So let's pull this all together.
Right.
If you have assets and you have debt, which is the whole topic of today's show, what is my thought process then? And we've talked about the specific assets, but in general, what's my thought process when I'm in that situation?
All right, so the first thing you need to do is identify which of your assets are at risk, which ones are protected. Because if it turns out all these things you think you own are protected, you don't really have assets that you need to worry about when dealing with your debts.
And the classic example would be the RSP. Well, if nobody can take it.
Well, and actually just as common, people worry about losing their cars. Well, if you've got a loan against your car and you're still making payments on it, you don't really own it. As long as you keep paying, you're going to keep it, so it doesn't get factored in.
Same like the apartment I rent. Well, it's not my apartment. I'm paying a fee every month to live there.
Yep,
So
same thing.
So, okay, number one, what assets do you have that could be seized, either because they're secured assets or because they're exempt?
Right.
What's number two then?
So number two then is what's the liquidation value of those things versus the balance of your debt? So if you've got $50,000 in a tax-free savings account that you could cash out and pay off $30,000 worth of debt, that may very well be the right solution. If you've got $30,000 in the tax-free savings account and $50,000 in debt, well, then just cashing out the tax-free savings account alone is not the right solution. We need to add a step.
And that final step would then be the consumer proposal then?
Correct, yep. And so you start by assessing what you own and what's at risk, and then you determine how does that balance compare or relate to what I owe. And then it's, all right, how many different options should I consider? And frankly, I don't think people should do this by themselves. It costs nothing to book an appointment with a licensed insolvency trustee. That's the smartest answer.
Yeah, like why try to be doing all this math and figuring out what the exemption limits are and how is equity calculated and what's the realization value of my RESP and all that kind of thing?
Well, and the critical component to all of this is not being bullied by somebody that you owe. Ooh. I mean, the collection agencies are calling you all the time. Well, look, cash out that RSP, cash out your tax-free savings account. Pay me today. I don't care about the other guys. Why don't you put $10,000 more on your Visa card so you can pay off your line of credit with me? All of that is great advice for them, bad advice for you.
Well, you can be bullied by your bank too.
Exactly.
So you owe some money to the bank. You've got an asset at the bank, an RESP, an RRSP, a TFSA, whatever. The bank, it's pretty obvious for the bank. Cash that in, pay us. They don't care about everybody else.
Right.
Whether I'd call that bullying or not, they're obviously acting in their best interest. You need a plan that solves all your problems, not just that one.
Right. So at the very least, do homework on the internet. But quite frankly, folks, as much as people may not want to do this, talk to a professional. So if you're not prepared to talk to a licensed insolvency trustee, I'm not sure who else is going to give you an honest answer. The bank isn't going to. Any of the credit card companies or people that you owe certainly won't. If you're into those damn installment loans, they're never going to give you an honest answer. You got to find somebody that you can trust.
Yeah, I mean, if you've got an accountant, a certified financial planner, particularly if they're a fee-only financial planner, we've certainly had a number of them on the show in the past, and I've got some coming up in the future. So they are, some of them are actually very good at understanding the big picture. And what they will do if it gets into the area of, detailed insolvency law, well, then they'll be referring you over to someone such as ourselves. But yeah, you don't want to be talking to the salesman to get advice on how you should be dealing with these things. Excellent, Ted. I think that's a great way to end it. Thanks for being here. So I'm going to add one final point, and that's to emphasize what you just said. There are a lot of nuances to what we just talked about here. We've explained the rules over whether an RSP is seizable in a bankruptcy, but, again, talk to an expert before you go cashing something in.
Right.
Because it's always hard for us when someone comes to us after the fact and said, oh, yeah, 2 months ago I cashed this in and I paid half of my debts. Okay, we could have done something different if we'd known sooner. By law, an initial consultation with a licensed insolvency trustee is free. So it doesn't cost anything. we don't charge an upfront fee. It's as simple as that. So, come in up front, and then perhaps you can avoid some costly mistakes. That's our show for today. Full show notes, including a transcript, including links to everything we talked about today. I'll even put links to Section 67.1 of the Bankruptcy and Insolvency Act, and information on how to contact a licensed insolvency trustee for that no-charge initial consultation can be found at hoyes.com. That's HOYES.com. Until next week, for Ted Michalos, I'm Doug Hoyes. That was Debt Free in 30.